Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Welcome, thanks for tuning in, and I've got good news for you. Phil Tarrant isn't here today. You're spared. I'm Phil's business partner, Alex Whitlock. Thanks so much for joining me. I thought this week, just having gone through a fairly painful experience myself recently in financing my latest investment property, which was a double block, which I purchased up in Deception Bay. I've bought several properties over the years. I'm obviously part of the portfolio that Phil and I share, and I had a really horrendous experience getting finance. I went, first of all, down the path with ANZ, thought it was going to go through, seemed a fairly straightforward deal. ANZ pulled the pin, and I ended up having to find another lender. So I thought it'd be valuable just to get a bit of insight into just the lending landscape out there. I'm an experienced investor, so I'm very pleased to welcome Brendan Dixon. Brendan, thanks for coming along.
Thank you very much.
Brendan is the principal of a mortgage broking business called Pure Finance. Brendan has a background in banking, originates from WA, over here now in Sydney. What brought you over here in the first place?
Look, at the time, it was just a huge opportunity for Bank West, where I was working, where they were doing a big East Coast expansion, and they were looking for fresh talent, I suppose, to bring over and join the ranks. And so I came across.
And originally, just offline, you mentioned that much as myself, that you're from a media background originally.
Yes, prior to that, I was in media. So I had definitely developed some thick skin doing that.
Yeah. So just before we get into it and looking at finance, one of the things that I guess I'm aware of, and you'd be aware of in the media as well, is there's obviously the media hype at the moment about the property market. I think it's disappointing in some fronts that the media that property is a media beater, but they just want something to report on, and you get these figures bandied about being a 40% overvalue of certain markets, and some bend it around saying that you may be looking at 40% drops, but you know how the media operate.
Yeah, we do. Yeah, unfortunately, it can confuse people, and it's always important just to remember that context is really critical in all these cases. So whilst they're saying, 40% reduction, and you've also got areas that have had no reduction this year in the last 12 months, and then areas that have dropped down quite a bit. So, and
I think that one of the problems with the blanket media coverage, and particularly from commentators who don't necessarily understand the property market, the whole market gets you get broad brushstrokes across the whole thing. So there is no one property market. There isn't even state-based markets. You don't even have capital city-based markets. It breaks down into sometimes individual houses, streets, and exactly. Even sort of smaller areas than suburbs. So when while it is in general a challenging time in terms of property, and it's also a sort of a challenging time in finance, I believe very strongly, and I purchased just recently up in Deception Bay that it is, this is my personal opinion, that it's always a good time to invest if you seek value and if you understand the market and if you buy at any one time below market value. And that's a critical thing, whether the market's going up or going down or sitting static, getting property at below market value.
Exactly right. Yeah. Buy and then wait instead of, waiting to buy, as they say.
So just again, to that purchase that I made, it was a good purchase. I used a buyer's agent. They looked into the market very carefully. They bought me 3 purchases previously. They've been very successful. And again, I bought 2 places in Queensland and I bought 1 place down in Hobart. Within the last sort of 18 months, they've all gone up in value. Queensland's not rocketing as Sydney had done over the last sort of 5, 6, 7 years, but that's been a really abnormal market, the growth that we've seen here. So I've been very pleased with the growth that I've seen. I had good growth in Hobart. In Brighton is the actual suburb just outside of Hobart. So when I came to buy these properties in Deception Bay, there's a change in demographic there. The zoning has changed quite recently. So there's just sort of movement in that particular marketplace. So a good purchase, it was $600,000 for the 2 blocks. I've got good credit, and my serviceability is good, and yet the deal was going to go through with ANZ, and that fell apart. It would be good to just give our listeners just a bit of an insight into sort of the mindset of lenders at the moment, and why a seemingly straightforward deal is sometimes falling on stony ground.
Yeah, exactly. I mean, you find situations just like yours where experienced investor, plenty of equity, good income, and has difficulty. What's happening at the moment is banks aren't wanting to take on any more risk than they need to. So they're applying higher living expense amounts than they used to, and adding in buffers. And unfortunately, once you've got multiple investment properties and they're trimming a bit off the rent that you receive, and they're also increasing the living expenses from both ends, so you're getting squeezed from both ends, and sometimes serviceability doesn't stack up anymore.
There's a couple of factors that are driving this with the banks. Just to cool down the investor market, APRA put some limitations on banks. What was the background to that? That was a couple of years ago that those limits were put in.
That's right. Yeah. So they set the 10% speed limit on investment lending, so they weren't allowed to grow their investment book by more than 10% per year, and that obviously slowed things down quite considerably. And then, of course, more recently, that's been lifted to try and level things out because it's had the required effect.
So things have slowed down a great deal. Do you think that the brakes have been put on too hard in terms of restrictions to investment lending?
Yes, absolutely. Yeah. I mean, it's a big knee-jerk reaction at the moment. We're watching to see what happens. Obviously, the Royal Commission report comes out next year, but in anticipation of that, all the banks are preempting what they need to do.
Yeah.
And some of them are pulling the lever too hard. We were at a CBA lunch not long ago, and they were saying to us, look, admittedly, we pulled the lever too hard on investment lending, and now we have a gap. And if you look at the media this morning, it's in the news. They have a $115 million gap
That's right,
in their book, and they need to fill it.
Yeah.
So, I mean, these guys are in the business of lending. They need to lend. So I expect that they're going to have to fill that gap pretty soon. So you're seeing aggressive pricing happening, but also the issue where the serviceability and the way they're assessing loans has changed. And so some people are still not qualifying for those better deals, and they're stuck,
So, Brendan, just looking at some of the clients that sort of are coming away at the moment who are looking to, maybe they are thinking about going into the investment market, maybe they've just bought somewhere and they've put a deposit down, they're looking for finance. Tell us a little bit about the kind of investors that you're seeing coming along, the kind of sort of financing challenges that you're helping them overcome.
Yeah. I mean, everyone's special in our view. No one fits into any one particular box. There's always a few options for everyone. But what we're seeing more so now is that, say we had, a person had 6 or 7 lender options previously, and now they've got 1 or 2. So we've got certain circumstances such as, the partner might be on a visa, or the deposit might not be genuine, or
So just to give a bit of amplification. So when you say the deposit might not be genuine, just give us a bit of sort of visibility as what that might be.
Yeah, so that can be, first-time buyers getting a gift from family, a non-refundable gift. It can be that's deemed as non-genuine.
And that's because, and in simple terms, that's because the lender wants to see a pattern of essentially putting money aside as opposed to a bag of money that's sort of dropped into their lap.
Spot on.
So it's really so serviceability really is the key, and ability to service and willingness to service.
That's right. Yeah. So you look at each person's circumstances. And once you've ticked off all these items, then you whittle down to your options. And previously there was more, and now there's a lot less.
Yeah.
There's still options out there, but what we're finding is people don't know what those options are.
So let's just talk a little bit about, we know some of the lenders that are restricted, and we know that some of the reasons why they're restricted, the Royal Commission, the APRA kind of guidelines around investment quotas. But there is a certain sector of lenders which are not governed by at least by the same APRA rules. That's the non-banks.
Correct.
So, and look, you've been in banking for a long time. You've been mortgage broking since 2011. Just in terms of looking at the non-bank sector, how has that changed in terms of its appeal to investors over, say, the last sort of 7 or 8 years since you've been in mortgage broking?
Yeah, sure. I mean, in many cases, they have become the only option. So, they provide excellent products. You've got your, Peppers and Liberties and other lenders such as those guys who have got niche products to suit investors. They're open for business and they're willing to take people on. So they're filling an enormous gap, and they're doing really well from it. The numbers are soaring.
Because I've worked in media for many, many years. I've been for a couple of decades in Australia, and I've also worked, I've cut my teeth in Australia launching the first mortgage broking magazine. So I'm very, very familiar with non-banks myself, and I understand what they are. I think it's worth just sort of giving a bit of explanation, because non-bank, it tells you what it isn't.
Yeah.
It's I always find the term non-bank sort of an interesting one, a little bit sort of confusing, but
sure.
So just in terms of sort of a bit of explanation, what is a non-bank in your mind?
Yeah, sure. So I mean, they're not an authorized deposit taking institution, so they're not set up for transactional banking. You can't walk into a non-bank and deposit money and do transactional stuff. So they're really just in the business of lending, and that's really the only difference. I mean, in terms of products, they still give you the money. The product is still available, to normal people, and you can access online. So it's
they're, essentially they're a custom built lender. They don't have any conflicts, I guess, internally. They don't have, sort of deposits or sort of, they don't offer financial planning or any other the services or insurance. Correct. They just lend. I'm personally a big fan of the non-banks. And again, if I go back to my scenario with Deception Bay, Pepper was the lender that came in and at pretty short notice turned that particular deal around. I'm very familiar, like I say, with the non-banks, but I think it's important to give a bit of visibility as to, sort of what these institutions are. In many instances, or in some instances, the non-banks are actually funded by the banks. They'll get wholesale funding from bank balance sheets. A number of the big four, there's one big four in particular that is a big funder of the non-banks, but then they will also get their money from the capital market. So through securitized lending. So they will package up loan products. They will sell them on the capital markets. They'll bring that money in and then lend that out, and then the whole process sort of goes around again.
That's spot on. So it can be, the only downside in some cases to these alternative lenders is that depending on where they get their funds from, they can be more affected by what's going on in the world with rates.
That's right, because the big banks have the most significant buying power when it comes to money because of their sheer size. So in essence, often, not always, it means when you're large, you can access the cheapest funds. Correct. But the non-banks are pretty nimble and pretty good. But you're right, there are times when certain things happen where at that particular point in time, it may price them up a little bit.
That's right.
But the benefit, I guess, is that they can move more nimbly. There's probably, they still have to lend responsibly. They need to make sure, the same as for any institution, they're going to get their money back from the borrower. Spot on. They need to make sure the property, to go through the same process of ensuring that the property is valued the same way that a bank would do. But so there are lenders out there. So what would your advice be to borrowers in terms of making themselves attractive as a borrower to a lender to pave the way, assuming that they're buying a reasonable property at a reasonable valuation in a reasonable location? How can borrowers sort of position themselves well to make sure they're going to qualify?
Yeah, sure. I mean, knowing your situation is probably the number one thing, of knowing what your living expenses are, what your expenditure is, and of course, looking after your loans, making sure you're paying them on time and that everything lines up, so.
What are some of the black marks? So say making sure you're making repayments. So tell me some of the things that are flagged with banks when you're putting an application. Let's say you earn good money, but you've got some credit impairment, or just talk us through some of the things you really want to avoid as a borrower. Yeah,
if you're looking to get finance ready, you should be making sure your credit card payments are being made on time, your car lease is paid on time, and that you know what your monthly living expenses are. So just so there's no surprises. Yeah. Because what's happened of late in the last 12 months with all these changes in lending isn't as much policy changes. It's about that verification piece. So they're spending a lot more time verifying your information. They're spending more time going through your bank statements to see if there's any unusual transactions, and then they're pinging us on that. They're querying that.
And they actually do go through bank statements now. And certainly in the old days, you would just tell the lender, the broker would say, or even the bank, I've taken loans out at branch level, and I've also, the vast bulk of my loans have been through brokers. Yeah. And you would just say, okay, how much do you earn? And let's have your pay slips. And what are your expenses? What are your monthly expenses? And you'd say, well, I spend very little, and you'd qualify for a loan, But now the banks not only look closer, they actually go through bank statements. And if you say that you are spending X, they can identify very quickly that you're spending Y and what you're spending it on.
That's correct. Yeah, I mean, that's the big change. Asking for bank statements. Years ago, they didn't ever ask for bank statements, just pay slips. But, unfortunately, there's people out there who have been providing bad pay slips to the banks, and the banks have not had the resources to necessarily check all the time. So now they need to cross-reference that payment is going to their account that they own, and they're also looking at what else is happening in the account. So it's not a big concern for average Joe, investor, but it's just something to be mindful of. And so we spend time understanding that aspect of a client so that there's a narrative around.
So Brent, I'd be interested to know, so for people who are thinking about making their first step into property investment. So for people such as myself, where I have a home loan, I've got a number of investment loans, and I've got a sort of a trust, set up where my loan's a house. I'm quite a complicated borrower. But for people who are looking to move into the market, sort of just, for their first investment, what sort of things are the banks going to look for in terms of what would make them a good borrower? So in terms of positive kind of credit-based things, and also things to sort of avoid.
Yeah, sure. I mean, if you've had a liability before, any sort of credit facility, and you've paid it on time, that definitely helps with your credit score. Not having any defaults or credit impairments, it's pretty easy to get a copy of your credit file and just do a quick check. But other than that, yeah, if you're on top of what your expenditure is and you're earning a regular income,
and showing that you've got that serviceability in your income, that you've
That's
got that capacity, because and just again, so to look at, say, for an investment property, the banks will calculate the rental income.
that's right.
It's obviously very hard to get it's not impossible, it's hard to get a positively geared property without putting in a substantial deposit, and you have to have saved to get that deposit. But so that the good thing is that you've got that rental income that's factored in. So it's really being able to show that you can service that shortfall.
That's right. Yeah.
What's your thoughts on credit card? I personally don't have credit cards. I got rid of mine. I can't be trusted.
Yeah.
I just, every time I've had them, I've run them up, and then the bank will go and extend without my permission my credit limit, and I go further in. And I've just now I just have a slush fund, which is my Visa debit, and I eat baked beans and rice that I find in the back of the cupboard when I run out of money. So so in terms of getting yourself sort of credit ready, would you recommend, if you're going to have a credit card, how's the best way to manage it?
Pay it off monthly.
Okay.
That's it. And it doesn't have to be a points card, because points cards come with annual fees. And so there's not often a huge benefit of paying that fee unless you're turning through heaps and heaps and heaps of money on that card and getting all the points.
My business partner, Phil Tarrant, loves a point on a credit card. He's a big fan of them, particularly Qantas. So, but I think you're right. You do pay for that. There is a cost associated with that, even though you get the benefit of points, towards flights and so forth.
That's right. Yeah. It's a personal choice. Yeah. Yeah. But looking after your finances and knowing how much you're spending and feeling comfortable with that means you're in a good position to buy. If you're in a position where you don't really know where your money goes, not really sure what you can afford, go through the process and work out, or speak to someone and find out how much you can borrow. But if you're not on top of things now, why do you think you would be once you've got an investment property?
Yeah. Just looking forward as well. So in terms of the borrowers that, let's look at your borrowers in general. How many people are coming to you now retrospectively who maybe took a variable rate out a while ago and saying, I'm thinking about fixing, or how many people coming in and looking at fixing, or, what are you finding trend? I'm not going to ask you to sort of look at the future because you're not an economist, but
Sure.
What are you seeing in terms of your clients?
Yeah, I'm seeing a big focus on fixed.
Okay.
Even from people who've never bought before, who are going through the process, and friends of friends or people around them, their peers, are suggesting fixed to them.
Okay.
And, people who aren't in the finance business, so it's interesting.
What are some typical sort of 1 year fixed rates at the moment?
Typical 3.59, 3.55 is the lowest you get in the market at the moment. And then
that's really low. I have to say, look, even you go back over the last couple of years, and for those that are looking, have been looking at the market for the last couple of years, it probably doesn't sound that exciting. But I mean, I bought my first property in 1998, and I bought in Melbourne in the South Bank, and the first loan that I had was about, I'm pretty sure it was about 7 or 7.5%, and I thought that was okay, because looking back into the earlier 90s, there were horror stories of 18, 19%. So, right. And I've bought, I've been buying now for for sort of 2 decades, and the prices of whether variable, whether fixed, whether 1 year, 3 years, 5 years, comparatively, they're very, very competitive compared to where rates have been historically.
Oh yeah, they're really cheap. In 2009, working for a bank, I was selling mortgages at about 6.7%.
Yeah.
So people who haven't had that experience don't understand that anything under 4% is magical. Especially, I mean, you can fix for almost 5 years with some lenders at that rate. So it's really good. But again, long term, if you're looking long term with your investment, and just manage it and review it in chunks, it'll be fine. You do the pre-work, you can afford it, and you'll be fine.
When I first came to Australia, which was 2001, and I settled on a property probably around that time, maybe 2002, and I had an ANZ loan which was 5.95, which was a variable, basic loan, and we went into a cycle then of just slow incremental 25 basis point increases. The RBA just chose to kind of go, so click, 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 and it was like a death of 1,000 cuts, and I was on a lower salary then. I had a couple of investment properties, and the noose just tightened around my neck, and I had a home loan as well, and it just got tighter and tighter and tighter. And each time that the rates went up 25 basis points, there was just that little bit less money to kind of go around, and it was quite tough. And eventually, variable rates, I seem to remember them going up to about 8, maybe 8.25% towards 2007, before the GFC came in, and then the RBA started lopping off 1% chunks of interest rates. So having seen a number of cycles, those kind of fixed rates, even the variable rate at the moment is really, very competitive, but it's not going to stay there forever. And even though some economists are forecasting maybe one more cut, it's not going to be like that forever.
It can't stay like that forever. And with that in mind, I mean, and looking back at what's happened in the past, it is an excellent time to borrow money. It's very cheap, and as long as you can afford to pay it back.
Yeah, and so I think that's a really, really important point. I think it is an excellent time to borrow money, and I think getting yourself so you're attractive to the lenders, be it non-banks or be it banks. The first thing is getting yourself in a good sort of set of financial health. So trimming down on the cutting the credit card limit, bringing it down, making sure you're meeting your repayments. So just getting yourself financially fit. Obviously, if you're in a position to save for a deposit, that shows that you're able to create that genuine savings, and it shows you can service a loan moving forward. So I think that kind of money being as cheap as it is a great it's a great time to borrow. The other, I guess, the dilemma is the marketplace is not rocketing, so you've then got to sort of pick your properties carefully.
That's right. Yeah, and I mean it depends on the market sentiment. People, whatever they think does tend to control the market. So if people think it's a bad time, then others will see that as a great time. So the experienced ones, that is, like yourself. So it is in our office. We're always saying at the moment we think it's an excellent time to buy.
I've found that hindsight's such a wonderful thing, and you look back when we started, Phil and myself started buying, I'd bought my own properties. I love property. I've bought property since I was able to afford it. Phil and I started building a portfolio about 6-7 years ago. We started buying out in Western Sydney at the time. I think the first place we bought was about $215,000 for a 3-bedder in St Mary's. I mean, you look at that now, and we were at an auction, and we were all excited, and we got the documentation, and we were with a buyer's agent, and there was some sort of ex-council houses being auctioned off and some various other assets. And our buyer's agent identified 3 properties. Went, okay, there's this one for 218, there's this one for 205, and there's this one for 215. And the first 2 went, and they went $1,000 over, and went, nah, we're out. That was it, because his position was, again, that it reached the price and I'm away. Hindsight, you look back and go, oh God, if we'd bought all 3 of those, imagine where we'd be. But the point being is that, you don't know that it's a good time until several years later.
That's right.
His philosophy and what's held us in good stead, and again, the fundamental is that he bought at what he knew at that time was below market value. And at that time, $215,000 for that 3-bedder in St Mary's on a 600 square metre block was at below market value. And he'd go and do his arithmetic, and he'd work out that his fee plus stamp duty and all the other associated costs, that was going to be what that place. So all those fees meant that we were still below what that place was actually worth. So
yeah. I mean, these are the factors, and but even if you don't necessarily get below market, if you're just paying what it's worth at that time, time is the biggest factor. If you just wait, you will make the gains, and this is I guess a problem with the people in the market, especially newcomers to the market, first-time buyers. They want everything now.
Yeah,
they want the big gains now. They've just seen what's happened, and they don't want to wait for it.
That's right.
So, but unfortunately, you can't control the market, and unless you're willing to do things like renovate and manufacture some growth in the property, you just have to wait. Yeah.
I think that personally, I believe you've got to really be rash to make a real mistake in property. I mean, I'm quite a rash person. This is why I buy property and not shares. I lose money in shares every time.
Right.
I go, I'll buy that, no research, and then it goes down the next day and I lose money. But with property, one of the reasons why I like property, and one of the reasons why I've stuck with property, is because it keeps me honest. Because you can't do things quickly. You can't buy quickly, especially not nowadays, because you have to make sure you got your finances in order. The great thing about buying property as well, one of the reasons why it suits me, is because I have people around me, such as yourself, a mortgage broker, who will give me some guidance. They're not going to give me investment advice, but you know what? They're going to look at the asset. I have a lender who's going to say, so I go, okay, I think I'll buy this property over here. My mortgage broker will help me look at whether it is going to be worth financing. Yep. I then get a lender that says whether they'll lend me money or not. And that in itself is saying, if they don't lend money on assets that they're going to lose money on. So if it's an 80% lend, they're 80% sure that they're at least going to get their money back. If it's 90%, then they get a mortgage insurer who is basically going to, pay to have me chase down for the money that if I can't fulfill the, the value of the property if they have to repossess. So you then get you get a valuation, you pay somebody, a few $100 and they go and value it and they go, yes, it's worth this amount. So I think you have to do, and even if you get it a little bit wrong, it doesn't disappear.
That's
it
right.
might drop a little bit temporarily. I think it's a great asset for average people such as myself to be patient. And I think to your point, if you look at the long game, you have an opportunity just to build wealth, and you put in a relatively small amount. You put in maybe 20%.
That's right.
So the impact of capital growth and compounding is really, really significant.
Absolutely. Yeah. You're just using finance as a tool to grow wealth, and it's a great thing, and it's a great thing that's available. You just have to make sure you tick the boxes.
For people who are homeowners who are listening in, how easy is it at the moment to look at leveraging off equity, assuming that it's there? How receptive are lenders to looking at sort of growth in terms of principal place of residence?
Yeah, in my opinion, they're very receptive. The banks are open for business, and whilst they're verifying things a lot more thoroughly, and there's extra buffers in place which are slowing some people down who've got multiple properties. Generally speaking, they want to lend. I mean, they're in the business of lending. So if you qualify, if you service the loan, then away you go. Yeah,
I think that using your home as sort of a deposit of money, I think that some people have taken money out of their homes in the belief that it's just going to keep going up 10% of value year after year after year for taking out bad debt. Use it to maybe pay for things where they're not going to realise that investment back. So look, holidays are great, but when you're sort of borrowing out of your home, it's a difficult thing. But I think that personally, I've used property I believe in leveraging. Yep. I've used my own properties, and Phil and I have refinanced our own portfolio several times, or individual properties, a number of times to extend that portfolio. We've kept the serviceability of our portfolio at about sort of sitting about 60% at the moment. So, even though it's gone up in value, we've not gone crazy and ripped out sort of huge chunks and reinvested. But I think used the right way, it's a really, really good way and a nice stable way to build assets. How are you finding lenders in terms of their appetite in terms of LVRs? What's the sort of the maximum LVRs these days?
You can still get 90% for investment with LMI capped on top. So LMI is obviously the fee that the bank charges when you borrow more than 80%.
Yes.
And they're very kind and they lend that fee to you and then they charge you interest on it, of course. So best to avoid it if you can. But yeah, you can still borrow 90% with LMI on top from a lot of lenders. And then, if you're buying for owner-occupied, you can borrow 98% from some lenders as well, including LMI.
Are there any kind of asset classes that you're finding lenders are not keen on? And so I remember sort of at the peak of the market, certain lenders didn't like lending on apartments below a certain number of meters and one bedders and studios and certain things. Are you seeing anything at the moment, just for those that think about borrowing or going to a certain area, that lenders are not keen to lend on?
Yes, there are some postcode restrictions, which is not necessarily about the size of the property, but just that area being quite dense.
Yeah, okay.
And then they're just worried about fluctuating prices. There's also the square meterage topic.
In terms of apartments?
Yeah, and actually I've seen in the last 12 months lenders loosen that up, which has been really good.
Again, because they've tightened too much?
Yep.
And so now there's a kind of, and banks have to lend money to make money. That's their bread and butter.
Spot on. And their understanding of the fact that Sydney property is quite blue chip, and these small properties are quite sought after, and so due to the demand, they're happy to lend against them at higher LVRs now. So you still can't get more than 80% on a very small apartment, but there's more lenders playing in that space now.
It'll be interesting to see if the media has done enough to scare the marketplace, to slow things down, sort of a short, sharp shock, as opposed to a sort of gradual slowing. I mean, things haven't fallen off. Some suburbs have been hit hard, but in general, things have slowed down.
Yeah.
It'll be interesting to see as the year wears on, and if now, what I'll be interested to see is if now is a great time to buy or just a good time to buy. But I think it's always a good time to buy if you buy the right asset.
Yeah, I agree with that completely. Yeah, definitely.
Brendan, it's been great talking to you. Thanks very much for taking time to come in. It's been a pleasure. For everyone else listening, thanks for tuning in. It's been great having you on board. If you listen to the podcast, don't forget to subscribe and recommend it to your friends. Get more people on there. There's plenty of podcasts on the site. You can find it at smartpropertyinvestment.com.au. I'm Alex Whitlock. Thanks for tuning in.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.